Look at the numbers, not the ones the talking heads are spinning on the evening news, but the cold, hard trade receipts leaking out of the Census Bureau this morning. It's over. The era of the single global supermarket is dead, and we're the ones being handed the bill for the funeral. The mainstream narrative wants you to believe this is some glorious, patriotic return to local manufacturing, but the math is screaming something much darker. Mexico just officially cemented its spot as the United States' largest goods exporter. For the second year running, they've eclipsed China. That sounds like a win, right? Reshoring, bringing the jobs back? Wrong. This isn't a return to the factory floors of the Midwest. It's friend-shoring, a fancy term for a system that's literally splintering our economy in half. You're looking at effective tariff rates hitting heights we haven't seen since the 1930s. We are back in a protectionist fever dream, but this time we don't have the domestic capacity to survive the sweat. The WTO is sounding the alarm about a fracture, but the noise is being buried by China Plus One headlines. You think your phone getting assembled in India or Vietnam instead of Shenzhen is just a change of address? Think again. The OECD is calling out a fragmentation premium, a structural 2 to 3% surcharge on every single thing you buy. It's a tax on geopolitical anxiety. Every time a supply chain moves to reduce risk, it hits a wall of massive inefficiency. Higher labor in Poland, infrastructure bottlenecks in the Indian corridors, and a massive tax for the privilege of trading with a friend. We're trading efficiency for security, and the bill is coming due at the grocery store, the gas pump, and the Apple store. The official statements call it resilience. I call it the permanent end of cheap. We've spent 30 years building a world that was fast and lean, and in less than 24 months, we've smashed it into expensive, jagged pieces. And here's the kicker, the hidden mechanism that the economists are too terrified to mention. Because while we're cutting ties with Beijing, the Chinese firms aren't actually leaving the game. They're just changing the jersey. They're pouring billions into Mexican industrial parks and Vietnamese assembly lines. We're paying a 20% premium for the exact same components just because they took a detour through a friendly port to get a different stamp on the box. The math is breaking. The made in China monolith is a ghost, and the real crash, it hasn't even started yet. You're being gaslit into believing this is a recovery when it's actually a controlled demolition of your purchasing power. To understand this fracture, you have to process the slow-motion car crash that started back in 2018. We were told it was a short, sharp shock to bring China to the table. 7 years later, that shock has become a permanent electrical fence around the global economy. The data isn't just shifting, it's mutating. By mid-2024, the Biden administration didn't just keep the old tariffs, they tripled down, 100% on EVs, 50% on solar, 25% on critical minerals, and then 2025 hit. The second Trump administration didn't just walk through the door, they blew the door off the hinges with a 145% tariff on Chinese goods. The mainstream narrative, the villain in this story, is the PR machine calling this the Great Resilience. They want you to believe that paying 19.5% effective tariff rates, the highest since the Smoot-Hawley disaster of 1933, is a small price to pay for economic sovereignty. But let's look at the math they're hiding. When you hike tariffs to 1930s levels, you don't magically spawn factories in Ohio. You create a fragmentation premium. The OECD is literally shouting into the void right now, warning that this selective trading is shaving nearly 1% off global GDP. That's not a rounding error. That's hundreds of billions of dollars in lost wealth, vanished from your retirement accounts and your purchasing power before you even wake up. And here is where the gaslighting gets truly insulting, the connector economy loophole. The villain isn't just a policy, it's the illusion of choice. We are told we are decoupling from China by moving production to Mexico and Vietnam, but look at the capital flows. Chinese greenfield investment into Mexico hit an all-time high of $195 million in a single quarter late last year. Private estimates from the Baker Institute suggest the actual stock of Chinese money sitting in Mexican industrial parks is closer to $15 billion. Do you see the game yet? We are friend-shoring with Mexico, but the friends are just frontmen. Chinese firms like BYD and Lingang Machinery are building 2,000-acre ghost hubs like the Hofusan Industrial Park near Monterrey. They aren't leaving, they're just putting on a Mexican poncho and charging us a 20% security fee for the trouble. The mainstream argument is that this shortens supply lines. Logic check. How does shipping raw components from Shenzhen to Mexico, assembling them with Chinese capital, and then trucking them into Texas make anything shorter or safer? It doesn't. It just makes it more expensive. When that trade index drops, it doesn't just mean a red line on a Bloomberg terminal. It means the last mile of inflation is permanent. The IMF and WTO are slashing growth forecasts for 2026 because the front-loading we saw earlier this year, companies panic buying before the tariffs hit, is over. Now we're in the hangover. The labor markets in the U.S. are softening, unemployment is creeping up, and yet prices aren't falling. Why? Because the fragmentation premium is a structural floor. You can't lower prices when your entire supply chain is paying a 2 to 3% geopolitical tax just to exist. The false hope they're selling is that mini-lateralism, these tiny exclusive trade clubs like the IEPF or the Mineral Security Partnership, will save us. They won't. They're just fancy country clubs that exclude the very resources we need to run a modern world. China still controls 60% of the rare earths. Indonesia just locked down 50% of the world's refined nickel. You can't friend-shore your way out of geology. The villain in this story is the belief that we can run a 21st century tech economy with 19th century protectionist walls. We're not building a fortress, we're building a cage, and the math shows the bars are getting closer every single day. To understand why this is happening, imagine the global economy as a high-performance racing engine. For 30 years, we tuned that engine for one thing and one thing only: efficiency. Every component was sourced from the absolute cheapest, most specialized shop on the planet. If a bolt cost a fraction of a cent less in Shenzhen, that's where it came from. The result was a machine that ran at terrifying speeds with zero margin for error. We called it just-in-time manufacturing. It was beautiful until the track changed. Now imagine we've decided that efficiency is a liability. We're pouring sand, literal sand, into the gears in the name of security. We've replaced that high-performance oil with a thick, sludge-like substance we call the fragmentation premium. This isn't just a metaphor, it's a mechanical reality. In a standard engine, you lose energy to friction. In the global economy of 2025, we are losing 2 to 3% of our total output to the friction of moving things between friendly ports. When you move a factory from a specialized hub like the Pearl River Delta to a friend-shoring site in Poland or central India, you aren't just moving machines. You are abandoning 3 decades of agglomeration effects, the tribal knowledge, the sub-suppliers who live 2 blocks away, the logistics networks that hum in their sleep. You are starting from scratch in a region where the electricity might flicker or the ports are clogged. That 3% premium the OECD warns about, that's the friction loss of a dying engine. It's the energy wasted trying to force a system designed for cooperation into a mold of isolation. And here is the mechanism that is about to snap: front-loading. In the first half of this year, we saw a massive artificial surge in trade. The official numbers looked great. Global trade grew by 4% in real terms. Why? Because every CEO with a brain was panic buying. They saw the 20% universal tariff coming. They saw the 145% wall being built around Chinese high tech. So they ordered everything: semiconductors, raw lithium, even basic textiles 6 months in advance. They flooded the warehouses. This created a fake boom. It made the economy look resilient, while underneath the hood, the engine was overheating. Now, as we sit here in late 2025, that front-loading has stopped. The warehouses are full of expensive, high-tariff inventory that consumers can't afford. The snapback is starting. The WTO just slashed its 2025 merchandise trade forecast from 3% growth to a 0.2% decline. This is the first time since the pandemic we've seen a reversal this sharp. It's a literal trade heart attack. I know, it sounds impossible. We were told the Made in USA or Made in Mexico label would save us, but here's the empathy trap. The reason the decision makers in DC and Brussels are trapped by their own math. They have to keep raising the tariffs. Why? Because they've run up so much debt trying to subsidize this transition that the only way to pay for the subsidies is more tariffs. It's a feedback loop of failure. They use tariff revenue to fund the CHIPS Act and the green subsidies, but those very tariffs raise the cost of the raw materials needed to build the chips and the batteries. So the subsidies become less effective, meaning they need more subsidies, which requires higher tariffs. They are trapped in a fiscal vice. They can't stop because the moment they lower the tariffs, the Made in China monolith, which is still 20-30% more efficient despite the death narrative, would flood the market and wipe out every friendly factory they just spent billions to build. The dominoes are already falling in a predictable tragic sequence. The security tax makes intermediate goods 15% more expensive. U.S. manufacturers pass those costs to you, but your wages are stagnant because the same tariffs are killing export demand for American goods. Demand collapses. People stop buying EVs, stop upgrading phones, stop renovating homes. The invisible crash. This is where the WTO's 7% GDP loss prediction becomes real. That's not a number on a screen. That's the equivalent of losing the entire economy of France and Germany combined. Gone. Vaporized by the friction of a fragmented world. The decision makers know the math is breaking. They see the ghost hubs in Mexico where Chinese firms are just slapping a HON Mexico sticker on a crate from Shanghai. They see the DXY, the dollar index, plunging because the rest of the world is terrified of our fiscal sustainability. But they can't admit it. To admit the friend-shoring reality is a failure is to admit that the last 5 years of geopolitical strategy was a billion-dollar mistake. So they double down. They build the cage tighter. We are no longer trading for profit. We are trading for survival. And in a world where everyone is just trying to survive, nobody actually thrives. The engine is seizing. The fragmentation premium is the new tax on existence, and the exit ramps are being closed one by one. Here is the ugly truth that the 2026 projections aren't telling you yet. We are entering the year of the sovereign hangover. For all of 2025, we've lived on the borrowed time of front-loading, companies panic-buying inventory to beat the tariff walls. But as of today, December 24th, 2025, that inventory is sitting in warehouses, and the new orders, they aren't coming. The WTO just slashed the 2026 trade growth forecast to a pathetic 0.5%. To put that in perspective, that's not just a slowdown, it's a flat line. The 2.4% growth we saw this year was a mirage created by fear. Now, the fear has been replaced by the math of the fragmentation premium. We are looking at a world where the cost of living doesn't just stay high, it structurally resets. The IMF is quietly modeling a long-term 7% loss in global GDP if this decoupling continues. That's not a recession, that's the permanent erasure of the middle-class dream of affordable technology and energy. So, what does the next 6 to 12 months actually look like? First, expect the connector economy to come under fire. The US and EU are already moving to close the Mexican and Vietnamese loopholes. They've seen the data on Chinese ghost hubs. By mid-2026, we're looking at rules of origin so strict they'll make the current USMCA look like a free trade pamphlet. If your product has so much as a Chinese-made microchip or a refined mineral processed in a non-aligned hub, it's going to hit a wall of 40 to 60% duties. Second, the great margin squeeze is here. In 2025, companies could pass some costs to you. In 2026, they can't. The consumer is tapped out, savings are at record lows, and the security tax is eating what's left. We're going to see a wave of idiosyncratic credit events, fancy talk for corporate bankruptcies, in sectors that relied on cheap, seamless global parts. If a company doesn't have a fortress balance sheet and a high gross margin, it's a zombie walking into a graveyard. Now, let's talk heart to heart. What do you actually do when the world decides to break itself? Pivot to real assets. In a fragmented world, paper promises like long-duration bonds are becoming instruments of financial repression. The smart money is moving into what the world needs but can't easily move: industrial commodities, energy infrastructure, and gold. Gold isn't just a hedge anymore. It's becoming a neutral reserve asset again because nobody trusts the other side's currency. The local skill set. If global trade is dying, the fixer becomes king. The era of just replace it with a cheap one from Amazon is ending. We're moving back to a world of repair, maintenance, and local specialized manufacturing. If you have the skills to build, fix, or optimize systems locally, you are the new elite. Community resilience. The Made by Allies network applies to your personal life too. In a 2026 economy, your mini-lateralism is your neighborhood and your local network. When the global engine seizes, the person who can trade value within a 10-mile radius is the only one who stays mobile. The Made in China monolith is dead, and the Made in Mexico replacement is a high-priced ghost. The mainstream wants you to stay optimistic while they manage a controlled demolition of the old world order. Don't fall for the recovery headlines in Q1. The real test comes in the summer of 2026, when the inventories run dry and the fragmentation premium becomes the only price on the tag. Trust the patterns, not the promises. I'll see you in the comments.